Well, in today's video, we'll continue with our series of using price action to taking an informed decision in the market. Today, at the time of recording on 12th of October, we are fully aware of the latest developments in terms of tariffs that the US plans to impose on China. I think Donald Trump said 100% or 130% increase in tariffs. He's been obviously saying that every few days, every few weeks, which is fine. That's his tool of getting a geopolitical edge. It's not a place to comment on whether it is good or bad, but what we can look at certainly is the price action that is there on offer and take decisions accordingly. So, like I have said all in several videos, we'll follow the same pattern. The objective, of course, is to evaluate it from a swing trading perspective or a shorter term trading perspective. So, we'll ignore the assessment on the monthly and weekly charts. Those assessments remain true for a very, very long time, and therefore, if anyone is keen on seeing what our view is on those time frames, you can just check the older videos that are recorded. So, the chart that I have in front of us is that of Nifty 50, and the time frame is the daily. And on the daily time frame, all we have to look at is the position of the current high. I mean, which should be very, very thematically easily visible. And let's just compare it with something earlier, and we can see that here we have the previous high. So obviously, at this point in time, the highest point of the market is definitely not above its all-time high, and this as a whole is a structural range. We are seeing irregular highs and lows, which becomes a structural range. We zoom into the process as of now and we focus on the lows, and what we see is that the lows that the market has created seem to form a pattern. That is, they seem to form a low of around 24,500 and a high of around 25,500, at which point it tends to get rejected. I'll remove these markings because now it has become very clear that a market which fails to create new lows or fails to create new highs is obviously a market which is ranging. And whenever a market is ranging, a trader has obviously multiple choices, but one of them being that they either buy the market in oversold conditions or they sell the market in overbought conditions. And of course, another alternative is that the trader simply ignores to trade a ranging market. That is, they don't build systems designed to trade a ranging market. When we are trading Nifty exclusively, we have to build systems to trade everything. That is, if we are only trading a specific chart like Nifty or crude oil or gold or some particular stock, those securities are going to trend, those securities are going to range, those securities are going to show breakouts and patterns and failures and successes, all of them together, and therefore we need to have multiple systems in order to tackle a single security. A trader who only uses trend following systems is going to have within their system a process of rejecting securities to trade. So point being that this is obviously a chart of a market which is not trending. I mean, it's visible, it's obvious, it's a matter of a few seconds to see. And if it's a chart of a stock or a security that is not trending, we should not go out there expecting that previous highs and previous lows will be decisively broken. Why is this information relevant? This information is obviously relevant because we saw that overnight the US markets corrected by almost 3.5%, and entire global markets were not very pleased with the announcement that Trump made. So with that in mind, that given that this particular security is ranging, what would be my approach to trade a range? So typically I don't trade ranges. What it means is that I will not have a Nifty exclusive position in my portfolio. But if I were to trade the security, I would trade the security in the direction of its longer term trend, which means the direction of the longer term trend is necessarily up. And if it is ranging on the daily charts, then obviously I would want to buy it whenever it gets oversold. So first step is obviously to establish some pattern of the lows, if there is a pattern in the lows at all. And when I connect the lows, I see that there is a sort of a weak trend line, the gradient or the slope is not significant. So such a slope, when it's not significant, can actually be quite well defended by the market. And on the higher side, obviously we are waiting for three confirmed tests. But on the higher side, we are still waiting for a test here and a potential breakout from this zone in order to confirm that this is breaking out on the range on the daily, and a breakout strategy needs to be deployed here. But for now, we will obviously exclude this because we don't have three confirmed tops, but it looks like we have three confirmed bottoms. And despite there being several thousand point corrections in the global market just on Friday late evening our time, I simply find it very difficult to imagine that Nifty is going to trade below 24,500. It's just very difficult to imagine that the market just gaps open. A 3% or a 4% gap down on the market is roughly 1,000 points. So that should ideally, I mean, the 3% gap down will bring the market right about here on the blue line, which I'm marking. And obviously, if it, on the day that it arrives, let's just visualize a scenario that the market actually opens up 3% lower, just the way the US markets have closed 3% lower, and the markets open here. So what is going to happen? Most likely, if you have any limit orders that are placed in the market, they are going to get traded. Simultaneously, if you have any stop loss orders in the market, they too will get traded, which means that the weaker positions in the market are going to get squared off and relatively stronger positions in the market are going to be built. But if the move closes here, or if it simply fails to reach back into the trend line within a couple of trading sessions, then in that case the market, that is, let's just for visualization, let's just assume that the market has gapped down and it's come here. So I'll just mark this with a blue line. We are like I said, our job is not to predict what the market is going to do. That's not really our business. Our job is simply to plan what we are going to do if the market does this. Now, once the market gaps open here, what happens is that once the opening candle low is formed here, any close till this black line on where I'm marking is going to mark a very strong bullish reversal candle, like a bullish counter attack, or maybe it could engulf this particular candle. And these kind of candles which are formed after a huge gap form very strong reversal potential. That is, they might actually be the low of the year even. That's a rich possibility that exists when a gap down candle is formed. Simultaneously, the possibility that exists is actually of this one, that is, a gap candle is formed, maybe it moves up, it rallies up higher, it retests somewhere around the previous high, and now it flattens out for some time, maybe a couple of days, and let's just assume that it decides to break down. Now, at this point in time, if you remember a video that we did a few sessions ago when the market was trading somewhere around here, where we said that there should not be more than 150 points on the downside on Nifty. It's very difficult to imagine that. But in that same video, we discussed that we will have to exit the positions if the market actually breaks this low. And the reason we gave for that was quite simple, that the previous low of 21,500 is simply too much, and a trader cannot see that low in their positions, and certainly not in their leveraged positions. So it will be best that if this scenario were indeed to happen, then we would have to book the losses and exit the market and exit the long positions on the daily time frames. That's for sure. So this is a possibility that the market actually gaps down, and the reason why we are evaluating this possibility, like I discussed, is the news inflow and the possibility and the 3% plus correction of the market. The other possibility is that the market does gap down, but it gaps down straight on the trend line. Now, if it gaps down straight on the trend line, what is going to happen is that your long positions, which were created, which would have been, you would be holding some long positions. Let's just assume you were holding some long positions here. If the security is to gap down on the trend line, these positions are not going to exit that soon. So you are not going to find any exits in the market. But what's going to happen is that as soon as it gaps down, certain buying orders will get traded. Certain buying orders will get traded. I'm sorry, I just got a message and I got distracted. So in the first gap down, if the market indeed does gap down by a couple of percentage points, then in such a scenario, you will add to certain long positions. And obviously, if the gap down continues downwards, that's when certain long positions will get closed, and if the previous move is to happen, then we would simply exit the position. But the favorable condition is it gaps down and rallies back up. In that case, you would be presented with an exciting opportunity of value picking on very short term time frames, and it looks reasonable. So obviously, once we have identified that this is a range, and when things are in a range, we generally expect them to remain in a range. We don't expect them to simply break down from ranges. That's rare. It's difficult to place a bet. So if I were on the market and if I'm seeing this range, it's clear. I mean, if I just mark this with a vertical line, maybe, perhaps, if it's possible, and I'll just darken this line here so we are on the same page. And if I simply add, like, say, an oscillator which I have added on the screen, RSI, you will see this is all oversold zone here. You will see the oversold zone here as well, and you will also see the oversold zone here. So whenever the market gets into a range, it becomes very reasonable to go long onto it in oversold conditions. And given that the previous move was right here in highly oversold conditions with the confirmation, it is natural for traders to be long. Having said that, the same market is in a range and it is in an overbought situation now. So it is again logical for traders to want to book profit. But to expect that a range is completely going to collapse despite this news is difficult. It's a difficult scenario to foresee. It's a difficult scenario to plan for. But we obviously know where we are going to structurally exit. We should obviously know how much it is going to cost us, and accordingly we should plan our trades. With that, I hope you have benefited from this video. The intention, of course, of all of my communication is to clearly establish that no professional trader goes out there predicting the market. They only plan for what is the worst possible thing that can happen to their position. And before creating the position, they're looking for some justification. So for example, if someone were to ask me, would I buy Nifty tomorrow? The answer is obviously no, because it's a ranging security in overbought conditions. So obviously I wouldn't buy the security tomorrow, but because it is coming in this direction. So if I'm long, it's not necessarily it is Nifty. It could be maybe Axis Bank, it could be Asian Paints, it could be Adani Ports, it could be anything with letter A to Z. I would obviously be long on those securities, and therefore all of my planning and all of my focus is what happens when the market goes against me. If the market, obviously if the market ends up breaking, say, let's say this resistance here, right here, decisively, I'll be the happiest person, perhaps one of the happiest people that's around, because this works favorably for me. But my planning doesn't involve that. My planning is only what is the worst case scenario, how much am I going to lose, what will I do next, will I short the market? And it is the answer to these questions that basically make one a better trader. And the role of technical analysis is simply to help you articulate your own thoughts better. I hope this message is communicated in the videos that I present. I am currently on a holiday in the mountains, a place which I love very much, and therefore there is a delay, but I also enjoy communicating through this medium. So thank you for your patience, and I hope you have learned something new today. Wish you all the best for the remaining week. Take care.